T accounts are one of the tools accountants use to analyze business transactions before they are recorded in the company's books. That means that T accounts allow us to visualize exactly what is happening in each account. Every account in accounting, whether it's cash, accounts receivable, equipment, accounts payable, revenue, or expenses, can be represented using a T account. The left side of the T account is called the debit side, or DR for short. The right side is called the credit side, or CR. A T account is simply a visual tool that accountants use to track changes in individual accounts. Think of it as a miniature version of the general ledger. And one of the biggest advantages of T accounts is that they make accounting visual. Let's all see how T accounts actually work, but this is important. Every transaction affects at least two accounts. Take this transaction for example, the business pays $500 cash to purchase office supplies. Let's think about what happened. First, the business now has more office supplies than before. That means the supplies account increased by $500. At the same time, the business has less cash because it spent $500. That means the cash account decreased by $500. This is exactly why accounting uses at least two accounts for every transaction. Something came in and something went out. As we record transactions in T accounts, we place the amount on either the debit side or the credit side, depending on the rules for that particular account type. Don't worry about memorizing those rules just yet, though. We'll cover them in just a moment. For now, the important idea is that T accounts allow us to see exactly how a transaction affects each individual account. And notice something else. Even though cash decreased and supplies increased, the accounting equation stayed in balance because one asset simply changed into another asset. No liabilities changed. No owner's equity changed. The business still owns the same total amount of assets. They're just in a different form. That's one of the reasons accountants love T accounts. They make the flow of transactions easy to see. Now we get to the part of accounting that scares a lot of students, debit and credit rules. But the good news is that there is a pattern, and once you see the pattern, it becomes much easier. Every account type increases on one side of the T account and decreases on the other side. So let's start with assets. Assets increase with debits and decrease with credits. Since cash is an asset, adding cash goes on the left side and reducing cash goes on the right side. Liabilities work exactly the opposite way. Liabilities increase with credits and decrease with debits. The same rule applies to owner's equity and revenue accounts. Both of these account types increase with credits and decrease with debits. Expenses are different. Expenses behave like assets. They increase with debits and decrease with credits. One trick that many accounting students use is to remember the acronym DEALER. Drawings, expenses, and assets increase with debits, and liability, equity, and revenue increase with credits. And that's how it works. Figure out what account increased and what account decreased. Identify the account category, and then apply the debit and credit rule with the help of the dealer mnemonic. Let's look at our first example. The owner invests $50,000 cash into the business. Cash increases, and since cash is an asset, we debit cash. Owner's capital also increased. Since equity accounts increase with credits, we credit owner's capital. The result is a $50,000 debit and a $50,000 credit. The transaction balances perfectly. Now let's look at this purchase of equipment for $8,000. Equipment increases, so we debit equipment for $8,000 because assets increase with debits. Cash decreases because we paid for the equipment. Since assets decrease with credits, we credit cash for $8,000. Notice that one asset increased and another asset decreased. The total amount of assets stayed exactly the same. They simply changed form. For our final example, let's purchase office supplies on account for $2,500. Supplies increase, so we debit supplies for $2,500 because assets increase with debits. Accounts payable also increases because we now owe money to a vendor. Liabilities increase with credits, so we credit accounts payable for $2,500. This time, both accounts increased. Assets increased and liabilities increased by the same amount. Once again, the accounting equation stays in balance. So why do accountants use T-accounts? T-accounts are really a visual tool. They help us see what a transaction will look like before it is posted to the accounting records. By drawing the T-accounts, we can visualize which accounts increase, which accounts decrease, and whether we should debit or credit each account. Once we've worked out the transaction using the T-accounts, we can create the journal entry. That journal entry is then posted to the general ledger accounts. The general ledger is the permanent accounting record of the business. T-accounts help us think through the transaction. The general ledger stores the official record of the transaction. That's why T-accounts are such a valuable learning tool. They allow us to see the flow of debits and credits before they become part of the accounting system.